Welcome to XM.com. You're watching today's daily market comment by Haralambos Bisuros. I'm Christina Marujos. The dollar extended its losses against most of its major peers on Tuesday, with traders becoming split on whether the Fed will deliver another 25 basis points hike at its May meeting or not. Following OPEC's decision to cut oil production and the consequent surge in prices, market participants timidly started tilting the scales towards another quarter-point increase, but a cocktail of disappointing U.S. data spread fresh doubts on what could be the wisest choice at the upcoming Fed gathering. Yesterday, the U.S. Labor Department reported that job openings dropped below 10 million in February for the first time since May 2021. Evidence of a cooling economy revived fears that the Fed's already delivered hikes could result in a deep downturn. Those fears currently translated to evenly split chances for another hike and no action in May, as well as a series of rate cuts, with rates anticipated to end the year at 4.2%. The ISM non-manufacturing PMI for March is coming out today, and expectations are for a small decline, but with the index staying safely above the boom or bust zone of 50. However, a negative surprise could very well spell more trouble for the US dollar. All three of Wall Street's main indices slid yesterday, losing more than 0.5% each. Considering that equities tend to rise when Fed pivot bets intensify, this seems strange. However, the broader picture suggests stock remain resilient despite yesterday's pullback. The Nasdaq remains above the key zone of 12,900, while the S&P 500 stays very close to the important area of 4150. But that zone could be easily breached on the next data point, suggesting the Fed may need to pivot this year. Gold traders took the most advantage of the dollar slide, with the precious metal surging and clearing the psychological zone of $2,000 an ounce as soon as the jobs opening data was out. With the market stubbornly sticking to its view that rates in the US will be cut later this year, the path of least resistance for gold may be to the upside. Today, the dollar seems to be trying to stabilize against most of its peers, gaining more ground against the wounded Aussie, but losing notably against the Kiwi. The Kiwi skyrocketed after the Reserve Bank of New Zealand confounded expectations and raised rates by 50 basis points, with policymakers agreeing that they must continue hiking rates to tame inflation. The divergence in policy approaches of the RBNZ and RBA suggests that the Kiwi may continue outperforming its Australian counterpart for a while longer. This was a daily market comment here at XM.com.